Howdy everybody, welcome back to Accounting 1101. We're in our unit on fixed assets, and in our video right now we're going to be taking a look at part year depreciation. Think about our accounting utopia. To start off here, think about the accounting happy land. The utopia where your debits always equal credits. The utopia where every asset you buy is bought at the beginning of the year or maybe the beginning of the month, and everything balances out perfectly. You know, accounting utopia, where we wish we could all just live happily all the time. Unfortunately, the real world is not accounting utopia. So today we need to talk about what happens when you don't buy an asset on July 1, or you don't buy that fixed asset on January 1. Every example we've seen so far assumes that we buy the asset at the beginning of the year or the beginning of the month. Well, that's not the way it works, obviously, in the real world. So, partial year depreciation. What happens when we buy something in the middle of the month or the middle of the year? How do we handle that? The good news is it's relatively simple. It's not that hard. We still calculate the depreciation as we would under straight line or DDB, double declining balance, but, and it's a big but for the first year, we prorate the depreciation expense for the amount of time we actually held the asset. And so we go ahead and calculate a full year, and then we adjust it for the actual number of months that we held it. So we see our example right here. Fixed asset placed in service on April 1 would only be depreciated for 3/4 of the year, or 9 out of 12 months. And I'm always counting on my fingers when I do these problems. Okay, so April, May, June, July, August, September, October, November. And, not December, 9 months. I about forgot that there was a December. Man, I shouldn't make videos before I've had coffee. So, that's the idea. We're going to work a few problems here that kind of show you how to make that calculation. Our general rule on the purchase date. If we buy that fixed asset between the 1st of the month and the 15th of the month, anytime in that window, we can kind of assume or treat it as having been purchased on day 1 of that month. As long as we buy between the 1st and the 15th, we'll go ahead and assume it was bought on May 1. If it's bought in the second half of the month, 16th through the 31st, we'll treat it as having been bought on the first day of the following month. And so anything bought on May 16th through May 31st would be treated as having been bought on June 1. Okay, so that kind of helps us from having to, calculate 27 days of depreciation or 14 days of depreciation or some kind of weird thing like that up front. So we kind of use that rule of thumb to make it easier on us. Let's do an example here. We got sandblasting equipment, and we all are familiar with that, I'm sure. Sandblasting equipment was acquired at a cost of $24,000, has an estimated residual value of $6,000, estimated useful life of 10 years. It was placed in service on October 1 of the current year, which ends on December 31. So we're talking about depreciating it for October, November, December. We're only going to depreciate it 3 months, October, November, December. And so out of the entire year of 12, 3 divided by 12, we're only depreciating it, 25% in year 1? So we need to consider how long we had the asset and what percentage of the year that we're going to depreciate it. Once we've done that, we can go ahead and calculate regular depreciation for the year, multiply it by that prorated percent right there. So $42,000 is what we paid. The equipment had a $6,000 residual value. So our depreciable cost is going to be $36,000. That's the amount we're going to depreciate. We have a 10-year life. We're going to divide that by 10. And I don't even need a calculator. I'm going to do that math in my head. $3,600 a year. That will be what we depreciate in year 2. Not in year 1, because we didn't have it for the entire year. We only had it for 25% of the year. So you see where I'm going with it. I'm going to take that yearly amount of 3,600, and I'm going to multiply it by 25%, which ought to be 900. So in year one, my depreciation would be 900 bucks, and 20Y5 would be 900. In the second year, we're taking a full year depreciation. So that second year, 20Y6 would be 3,600. So that's the game we're playing. We're going to calculate a full year amount that we're going to depreciate, and then we're going to prorate it according to how long we really had the asset during the year. Let's do DDB real quick. Exact same scenario, only now we're going to calculate DDB, double declining balance. And again, you can see we've got the exact same setup. October 1 is when we put it into service, and we're talking October, November, December, 3 months out of 12, or 25% of the year. So DDB, we need to double the straight line rate. Useful life of 10 years, 1 over 10, be 10%. We double it. We multiply that by 2, we get a rate of 20%. So in year one, we'd have 42,000. We are ignoring the residual value in DDB until the very end, so I don't need to factor that in right here. We're going to multiply that by 20%. 42,000 times 20%, give me 8,400. Now I can't take the entire amount, I'm only taking 25%, because I only had it from October through December. 8,400 times 25% gives me 2,100. That would be my depreciation in year one. 20Y5, 2,100 bucks. Okay? So we move to year two. In DDB, we're always looking at the book value and multiplying it by that DDB rate. So our book value would be 42,000 minus accumulated depreciation, only 1 year. So 42,000 minus 2,100. We get some weird number here, 39,900. That's our book value at the beginning of year two. We'll multiply that by our 20% rate. 7,980. So that would be my depreciation for year two. We're taking the full year. I don't need to prorate it because we have it for the entire year. So that's the idea. You make your calculations as you would normally, and then you prorate it for the amount of time that you really held the asset in year one. On the back end, if we decide to dispose of an asset before the full year of depreciation is up, we kind of have to do that on the back end as well. And so maybe we dispose of an asset in May instead of holding it until December, or whatever the case might be. Then we would calculate a partial year from January to the point of disposal in May. And so it's not just something we deal with at the beginning. We also deal with it on the back end when we dispose of a fixed asset. But the procedure is the exact same. So if you know it one way, you know it the other way. We got one more video in our series on fixed assets. We're going to talk about how to handle it when we dispose of a fixed asset. And so I hope to see you back here for that, and we'll wrap up our discussion on fixed assets. Take care, everybody. We'll see you next time.